Welcome to our channel. We are so glad you found your way here. Let us help you fall asleep. Let's begin with the quiet collapse of AltaMIRA, the failure of the early mutual fund. Take a slow, deep breath in and release it. Even the tallest towers eventually quiet down. Tonight, we gently explore the empty boardrooms and forgotten ambitions of the past. Your mind is calm, and we are ready to begin. Founded in 1985, AltaMIRA emerged in a landscape ripe with potential. The visionaries behind it sought to democratize investment, allowing individuals access to wealth previously reserved for affluent investors. In the early years, the company positioned itself as a beacon of innovation within a nascent industry. It offered mutual funds designed to simplify the complexities of investing, catering to a diverse clientele seeking financial security. This region of financial planning thrived on the promise of consistent returns and the pooling of resources. As the firm grew, it embraced technology, leveraging early computing systems to manage portfolios and track performance. The founders believed that transparency and accessibility would foster trust and encourage participation from a broader audience. Marketing campaigns emphasized financial literacy, aiming to empower individuals to take control of their financial futures. Initially, it experienced a surge in interest, with assets under management increasing steadily. Investors were drawn to the allure of professional management and diversified holdings. The mutual fund industry was evolving, and many believed AltaMIRA would be at the forefront of this transformation. Yet, beneath the surface, challenges began to arise. Market fluctuations, regulatory changes, and shifting investor expectations slowly began to strain the foundations of this ambitious venture, foreshadowing the struggles to come. The founders of this venture were an ambitious group, visionaries who sought to redefine investment strategies during a period of significant economic transformation. With backgrounds in finance and asset management, they pooled their expertise to create a structure that promised growth and stability. This collective vision birthed AltaMIRA, a name imbued with aspirations for mutual prosperity. Initial investments were promising, as early backers saw the potential for diversification and risk mitigation through pooled resources. The idea resonated with an emerging class of investors eager for opportunities that traditional avenues did not provide. These early adopters contributed capital, buoyed by an optimistic outlook on market performance. Amidst the optimism, a series of strategic decisions were made, setting the stage for AltaMIRA's unique selling proposition. The founders touted a focus on high-growth sectors, attempting to capitalize on technological advancements and evolving consumer behaviors. However, this approach required a level of foresight that proved increasingly elusive. As the initial wave of enthusiasm began to wane, market dynamics shifted, revealing vulnerabilities in this ambitious framework. The founders' strategies, once heralded as innovative, began to falter under the weight of intense competition and an ever more complex financial landscape. This environment gradually exposed cracks in the foundation of their once promising enterprise. The concept of mutual funds emerged as an innovative approach to investment, characterized by pooled resources from multiple investors. This structure allowed individuals to gain access to a diversified portfolio, minimizing risks associated with single-stock investments. Investors could partake in a broader array of assets, from stocks to bonds, without needing substantial capital. A key defining characteristic was professional management. Fund managers were tasked with making informed decisions based on market analysis, trends, and economic indicators. This expertise was intended to enhance returns for shareholders who entrusted their capital to these financial stewards. Transparency in operations also formed an essential aspect of the model, with comprehensive reports provided to investors detailing performance and strategy. Liquidity offered another significant appeal, as shares could typically be bought and sold much easier than direct investments in individual securities. The convenience of a mutual fund allowed investors to adjust their portfolios without the complexities of direct management. Amidst these advantages, the inherent risks persisted. Market fluctuations could lead to declines in value, and management fees consumed a portion of potential gains. The fundamental principles that underpinned the mutual fund model were initially met with enthusiasm, promising a new avenue for wealth accumulation. Over time, the challenges of execution and market dynamics began to reveal a more nuanced reality. Investment strategies during the 1980s underwent significant transformation, driven by shifting economic landscapes and growing investor sophistication. This period marked a departure from traditional methods as financial innovation gained momentum. Institutional investors began to dominate the market, favoring more complex instruments that offered varied risk and return profiles. Amid this evolution, the emergence of technology played a pivotal role. The introduction of personal computers and sophisticated software provided investors with unprecedented access to data and analytical tools. They could now analyze market trends and make informed decisions at a speed previously unimaginable. These advancements fueled a competitive environment where agility and foresight became paramount. While mutual funds like AltaMIRA aimed to simplify investment opportunities for the average consumer, they increasingly found themselves at odds with a market that favored tailored, individualized strategies. The proliferation of index funds and exchange-traded funds reshaped investor preferences, offering lower costs and greater transparency. These alternatives attracted capital away from traditional mutual funds, creating an atmosphere of heightened competition and pressure. Amidst this backdrop, AltaMIRA struggled to adapt to the rapid changes occurring within the investment landscape. Its once promising model lost appeal as investors gravitated toward more dynamic approaches, leaving the fading company to contend with a legacy that no longer resonated with its audience. The initial public offering marked a pivotal moment for AltaMIRA, igniting hopes among its stakeholders. Anticipation surrounded the launch, fueled by projections that suggested a robust demand for shares, reflecting a belief in the company's innovative potential. Investment analysts forecasted an upward trajectory, predicting substantial returns as the mutual fund sector showed signs of growth. These expectations painted a bright future, with promising figures suggesting that AltaMIRA could capture a significant market share. Initial enthusiasm translated into high initial valuations, as investors clamored for a piece of what was believed to be a transformative entity in the financial sector. The atmosphere during the IPO was charged with optimism, as the company unveiled various strategies that aimed to differentiate it from competitors. They presented a vision that included unique investment strategies and targeted marketing efforts designed to allure a diverse clientele. The initial trading days saw a surge in stock prices, reinforcing the positive sentiment that surrounded the offering. Yet, beneath this surface optimism lay the seeds of future challenges. While the IPO was initially hailed as a triumph, the subsequent months revealed cracks in the foundation. Investor confidence began to wane as anticipated results failed to materialize, leading to a gradual decline in market activity surrounding the stock. The initial hopes had not taken root as expected. Early marketing strategies aimed to attract the first investors were characterized by a blend of optimism and bold claims. Promotions emphasized the potential for substantial returns, presenting mutual funds as accessible pathways to wealth. Brochures and advertisements painted vivid pictures of financial growth and security, targeting individuals seeking stability in an uncertain economic landscape. The nascent company utilized traditional media channels, including newspapers and radio, to disseminate its message. Events and seminars were organized to educate potential investors about the concept of mutual funds, which was relatively new at the time. These gatherings promised clarity and confidence, positioned as opportunities for engagement with financial experts. It fostered an atmosphere of trust and reassurance. Despite the well-crafted messaging, underlying challenges persisted. Investors were often hesitant, grappling with skepticism about the mutual fund structure and its inherent risks. The allure of collective investment was overshadowed by doubts about management fees and market volatility. As individuals sought to safeguard their financial futures, caution prevailed over enthusiasm. The company's initial outreach efforts met a swiftly evolving competitive landscape. The emergence of alternative mutual funds offered investors a variety of choices, each promising diversified portfolios and professional management. These alternatives, often backed by established financial institutions, attracted a growing clientele eager for solid returns and reliable guidance. With the proliferation of these investment options, this region became saturated with offerings that varied in strategy, risk, and expense ratios. Investors found themselves inundated with advertisements highlighting the merits of lower fees and higher returns, creating an environment where AltaMIRA struggled to distinguish itself. The shifting priorities of the market further complicated the situation. Innovative firms introduced index funds, appealing to a demographic that sought simplicity and cost efficiency. As these products gained popularity, they began to redefine investor expectations. It became evident that this fading company could not compete on price alone. More established players leveraged their reputations and resources to dominate marketing channels. Product differentiation proved to be elusive. While other firms adapted swiftly to market trends, AltaMIRA remained anchored in its traditional methods, failing to pivot in response to changing investor sentiments. The reluctance to innovate became a significant barrier, leading to a gradual erosion of market share and diminishing trust among potential clients. This stagnation would leave a lasting impact on its ambitions and future viability. The management of AltaMIRA was a complex web of decision-makers, each contributing to the fund's overall direction. At the helm was a board of directors composed of seasoned professionals who were entrusted with guiding its strategic initiatives. While these individuals possessed considerable expertise, the structure often led to a diffusion of responsibility. This lack of clear accountability hindered decisive action during critical moments. Investment managers, responsible for portfolio allocation, operated in a climate increasingly marked by uncertainty. They faced challenges in adapting to swiftly changing market conditions, often relying on outdated strategies that no longer resonated with investors. The absence of an agile management approach stifled innovation, resulting in missed opportunities and a growing disconnect with the evolving financial landscape. Communication among the various levels of management was stilted, further complicating the decision-making process. This region of oversight became characterized by bureaucracy, where ideas languished without sufficient support or resources for implementation. Stakeholders were left awaiting updates, often feeling detached from the operations that directly impacted their investments. These layers of management once thought to provide stability. Initial performance metrics revealed early gains that sparked initial enthusiasm among investors. Returns were promising, presenting a facade of success that drew in a diverse array of stakeholders. These figures, prominently displayed in marketing materials, suggested a bright future for the fledgling mutual fund. Investor sentiment surged as reports of above-average returns circulated, creating an atmosphere ripe for participation. Confidence flourished during these early months, with many individuals believing they had found a secure avenue for their financial futures. The allure of steady growth and the potential for substantial dividends acted as a magnet, attracting both seasoned investors and newcomers alike. This optimism was palpable, driving further investments and expanding the fund's reach within the financial markets. Yet beneath the surface, challenges began to emerge. The initial performance, buoyed by favorable market conditions, masked the underlying vulnerabilities within the fund's structure and management. As expectations grew, so did the pressure to sustain these gains. The optimism that had initially characterized investor sentiment began to falter as reality set in. Performance metrics that once sparkled began to dull. This gradual shift in perspective highlighted a dissonance between perceived success and the fund's operational intricacies. Stakeholders slowly started to question the sustainability of these early gains, laying the groundwork for a more profound reckoning. The echoes of this sentiment would resonate throughout the unfolding narrative. The regulatory landscape during the emergence of mutual funds was shifting, presenting substantial hurdles for early entrants like AltaMIRA. This sector was marked by an evolving framework, where compliance became an increasingly intricate maze. It was not merely a matter of adhering to existing regulations. The company faced the daunting task of anticipating impending legislative changes. Navigating the labyrinthine requirements demanded acute attention to detail and resources that were often in short supply. As rules became more stringent, a culture of caution took root. This environment stifled innovation, compelling leaders to prioritize compliance over strategic growth. Executives at the fading company found themselves entangled in layers of bureaucracy, often diverting focus from core investment strategies to ensure adherence to regulations. Consequently, operational agility diminished. The once promising momentum began to falter under the weight of compliance obligations. Internal audits multiplied, creating a climate of unease and uncertainty. Decision-makers were forced to allocate significant time and energy to manage these challenges, detracting from the company's ability to respond to market shifts or pursue new opportunities. The impact reverberated through every level of the organization. Employees, once inspired by the potential of mutual funds, grew disillusioned, observing how regulatory compliance overshadowed ambition. This atmosphere not only hampered growth, but also eroded stakeholder confidence, laying bare the vulnerabilities that would. The role of financial advisors played a critical part in the trajectory of this fading company. Initially, they embraced AltaMIRA with optimism, positioning it as a pioneering entity within the mutual fund landscape. Promoting its products to clients, they highlighted the potential for lucrative returns and the promise of diversified portfolios. Trust was paramount in these relationships, and advisors sought to instill a sense of security surrounding investments in this emerging market. As difficulties began to surface, advisors found themselves grappling with the challenge of maintaining client confidence. The allure of AltaMIRA offerings diminished, revealing a growing skepticism among investors. Consequently, many advisors adjusted their strategies, pivoting towards more stable, established funds. This shift illustrated a significant divergence from the initial enthusiasm that characterized the early days of collaboration. The erosion of trust permeated this region as advisors faced increasingly difficult conversations with their clients. Clients once eager to invest sought clarity in the face of uncertainty. Advisors, now burdened by doubt, struggled to articulate the future of AltaMIRA. The disconnect between advisor expectations and reality contributed further to the company's decline as investments dwindled. In this context, the initial promise of growth transformed into a landscape marked by hesitation and retreat, underscoring the fragility of relationships intertwined in the financial ecosystem. The unfolding narrative serves as a testament to the inherent vulnerabilities within the mutual fund sector. The importance of portfolio diversification remains a cornerstone of investment strategy, yet this principle was not fully embraced by AltaMIRA. This firm positioned itself as an innovator, promoting a singular vision that emphasized high returns predominantly from a select range of industries. Such a narrow focus inevitably led to exposure in volatile markets, where fluctuations became detrimental. Investors drawn by promises of consistent gains often overlooked the risks associated with a concentrated portfolio. The allure of performance overshadowed the fundamental need for a balanced approach, leaving many vulnerable during economic downturns. When crises struck, the lack of a diversified strategy revealed itself, exposing gaps that had previously been masked by short-term successes. This region, once bustling with investment activity, now stands as a reminder of the consequences of insufficient diversification. Resources that could have been allocated across various sectors were instead tied to a singular narrative. Consequently, when certain markets faltered, it became apparent how fragile this approach truly was. The failures of AltaMIRA resonate beyond its own borders, serving as a cautionary tale. Firms that adopt a myopic investment philosophy often find themselves at the mercy of external forces, illustrating the critical necessity of diversification within investment frameworks. The lessons gleaned from this decline echo throughout the financial landscape, urging future endeavors to embrace a more holistic view. Economic conditions during the 1980s were characterized by unprecedented market volatility. This period saw fluctuating interest rates and rampant inflation, creating an unstable environment for many financial institutions. The early mutual fund, once heralded as a beacon of growth and diversification, struggled to adapt to this turbulence. These circumstances resulted in investor uncertainty, leading to a significant withdrawal of capital from funds that had previously thrived. This region of financial history illustrates how external factors can profoundly influence institutional stability. High inflation rates diminished purchasing power, causing individuals to reconsider their investment strategies. Many turned towards more traditional asset classes, seeking refuge from the unpredictable swings of the market. The allure of mutual funds began to fade, replaced by a growing skepticism among investors. Management teams, faced with declining asset bases, wrestled with the decision to adjust their investment strategies. Some attempted to pivot towards more aggressive allocations, while others opted for conservative approaches, striving to retain existing clientele. The competition intensified as newer investment vehicles emerged, promising better returns and lower fees. These ruins of early mutual funds stand as a testament to the fragility of financial innovation amidst economic strife. Lessons from this era remain relevant, serving as a reminder of the necessity for adaptability and resilience in the face of shifting market dynamics. Investor demographics played a crucial role in the early mutual fund landscape. The focus shifted towards the middle-class investor, aiming to provide access to financial markets previously reserved for the affluent. This demographic sought stability and a sense of security during a time marked by economic fluctuations. The appeal of mutual funds lay in their promise of diversification and professional management, concepts that resonated deeply with those who were apprehensive about direct market involvement. Promotional strategies emphasized simplicity and accessibility, presenting these investment vehicles as a pathway to wealth accumulation. Though the initial reception was warm, the underlying complexities often went unaddressed. Many middle-class investors, drawn by the allure of easy entry, lacked the financial literacy necessary to navigate the intricacies of fund performance and market volatility. Communication strategies failed to evolve alongside investor expectations, leaving many feeling disconnected. As the years progressed, the landscape began to shift. A growing awareness of fees and expenses surfaced among investors, leading to dissatisfaction. The trust that had been cultivated eroded slowly, revealing a fragile foundation built on promises that did not always align with reality. This demographic shift, coupled with an increasingly sophisticated investor base, marked the decline of early mutual fund popularity. The once promising endeavor began to falter, overshadowed by the complexities of market demands and investor needs. The fund's investment philosophy, rooted in the dichotomy of growth versus value, became a focal point of contention among its management team. Growth strategies aimed to capitalize on emerging companies with the potential for significant earnings expansion. Proponents believed that investing in fast-growing sectors would yield substantial returns, driven by innovation and market trends. This approach, while appealing, often led to inflated valuations, leaving the portfolio vulnerable to economic shifts. Value investing, on the other hand, sought to identify undervalued companies with solid fundamentals, often overlooked by the broader market. This methodology promised stability and long-term gains, appealing to more conservative investors. The conflict between these two philosophies created an internal rift, as differing opinions on risk tolerance and investment timelines emerged. As the economic landscape shifted, the inability to reconcile these approaches resulted in erratic performance. Investor sentiment began to wane as returns failed to meet expectations. The once enthusiastic followers of the mutual fund grew skeptical, their trust eroded by inconsistent messaging and lack of coherent strategy. This region, once buzzing with optimism, now echoed with uncertainty. A gradual withdrawal of capital ensued, further straining resources. The fading company struggled to adapt, caught in a cycle of reactive decision-making. Early on, it experienced a series of remarkable successes that positioned it as a pioneer in the mutual fund landscape. Investments in burgeoning industries, particularly technology and healthcare, yielded significant returns. These ventures showcased the potential for growth, elevating investor confidence and attracting substantial capital. Initial offerings appealed to a broad spectrum of individuals, from novice investors to seasoned financial gurus. With a focus on diversified portfolios, it managed to mitigate risks while capitalizing on market trends. The early years demonstrated a keen ability to identify promising opportunities, allowing it to build a reputation as an innovative force. As returns flourished, the firm gained a loyal customer base that began to trust its judgment. Financial performance consistently exceeded expectations as the bullish market conditions of the late 20th century played a favorable role. Its strategies, once viewed as daring, became the benchmark for competitors. This success fostered an environment where ambition thrived, encouraging bold initiatives and expansion into new territories. Despite these achievements, the foundation laid during this prosperous era would later reveal vulnerabilities. As challenges emerged, the initial triumphs could be seen as a double-edged sword, offering a glimpse of what could be, while masking the underlying fragility that would eventually lead to its decline. The contrast between past glory and current struggles became increasingly pronounced. Investment platforms designed by AltaMIRA once showcased innovation and promise. They emerged as tools aimed at revolutionizing client engagement and portfolio management. Their architecture, initially lauded for its user-friendly interface and advanced analytics, was intended to provide investors with insights previously reserved for seasoned professionals. This technology flourished in an era where digital transformation seemed inevitable, reflecting the company's commitment to modernization. Initially, users embraced these tools, drawn to their potential for simplifying complex investment strategies. Data visualization and real-time updates fostered a sense of empowerment among clients who found themselves navigating the financial landscape with newfound confidence. The promise of enhanced decision-making capabilities resonated deeply within the market. Over time, however, this technological advantage diminished. Competitors emerged, introducing superior platforms that outperformed AltaMIRA offerings in both functionality and user experience. The once cutting-edge tools began to feel outdated, overshadowed by innovations that captured the attention of investors seeking dynamic solutions. This decline in competitive edge revealed a disconnection between AltaMIRA's original vision and the evolving landscape of digital investment. Consequently, user engagement waned. Disappointment settled in as clients sought alternatives, leaving the fading company grappling with the consequences of technological stagnation. The investment platforms, once symbols of progress, became relics of a past that could not adapt to the relentless march of change. Management disputes plagued the organization, creating a rift that weakened its foundation. Diverging visions among leaders led to confusion regarding strategic direction. Some executives advocated for traditional investment methods, while others pushed for innovative approaches that aligned with the evolving market landscape. Disagreements intensified, resulting in a fragmented decision-making process that hindered timely responses to emerging challenges. As internal strife escalated, the once cohesive leadership team descended into a cycle of blame and defensiveness. Meetings, which were once productive, devolved into contentious debates, leaving critical decisions unmade or delayed. This atmosphere of uncertainty stifled creativity and fostered a culture of fear, where employees hesitated to propose new ideas for fear of retribution. The impact of these conflicts rippled throughout the organization, manifesting in missed opportunities and diminished investor confidence. The inefficiencies of a paralyzed leadership structure became evident in the company's inability to adapt to regulatory changes and technological advancements. As market competitors embraced agility, this organization remained tethered to outdated practices, further exacerbating its decline. The once promising mutual fund, which had aimed to democratize investment opportunities, struggled to maintain its relevance. Gradually, the weight of misaligned priorities and internal discord led to a loss of trust among stakeholders, marking a turning point in its trajectory toward irrelevance. The first signs of trouble emerged as performance metrics began to falter in key sectors. This decline was not an isolated event. It spread through various investment portfolios, reflecting a broader malaise within the organization. Investors, once optimistic, started to voice their concerns as returns failed to meet established benchmarks. The initial signs went largely unnoticed, masked by a lingering sense of confidence among the upper echelons. Discrepancies in financial forecasts compounded the issue. Analysts tasked with projecting growth rates struggled to reconcile optimistic projections with the realities unfolding in the market. As underperformance became more evident, pressure mounted. Investors began to withdraw capital, undermining the already fragile financial foundation. Internal discussions revealed a growing rift between management and fund managers. Strategies that once thrived in a booming market now seemed ill-suited to navigate changing economic conditions. This disconnect led to a cycle of indecision, further exacerbating underperformance. As the months rolled on, critical sectors such as technology and healthcare, once viewed as pillars of strength, began to falter. This decline did not go unnoticed in the media, where analysts began to question the viability of the firm's investment strategies. The narrative shifted, creating an environment of skepticism that would prove difficult to reverse. Trust, once the cornerstone of its operations, began to erode steadily. A profound sense of unease permeated the market as investors absorbed the implications of dwindling returns. Initial confidence morphed into skepticism, with many questioning the viability of this financial institution. The once vibrant trading floor grew hushed as whispers of discontent circulated among brokers and financial analysts. Shares began to fluctuate erratically, reflecting a growing disapproval from a once loyal base. The steady stream of capital that had once flowed into funds transformed into a slow trickle as many opted to withdraw their investments. This retreat was not merely a reaction to disappointing performance, it symbolized a deeper betrayal of trust. As withdrawals increased, the financial institution faced mounting pressure to stabilize its position. It attempted to reassure stakeholders through public statements and strategic revisions. Yet, the challenge lay in convincing a skeptical public that the situation could be rectified. In this region, analysts frequently examined the shifting landscape, noting that many investors sought refuge in more stable alternatives. The emergence of rival firms promising transparency and better performance further fragmented the remaining support. reports indicated a marked decline in new subscriptions, signaling a loss of faith that would have long-term repercussions. Dwindling returns echoed throughout the financial community, marking a pivotal turning point in this institution's trajectory. What was once a beacon of hope for many now lay in a state of quiet disarray. Media coverage became a significant factor in shaping public perception, transforming the narrative surrounding AltaMIRA. Initial reports heralded it as a groundbreaking venture, a revolutionary model in the financial landscape that promised wealth and security. The glowing articles and enthusiastic endorsements painted a picture of unassailable success, drawing in investors eager to partake in the prosperity that seemed just within reach. As cracks appeared, the tone of the coverage shifted. Investigative pieces began to surface, revealing inconsistencies in financial reporting and managerial decisions that had eroded trust. Analysts scrutinized the once cherished principles of transparency, dissecting complex strategies that were now viewed as obfuscation. The change in narrative echoed throughout this region, creating an atmosphere of uncertainty and skepticism. The once loyal clientele started to question their investments, influenced by the barrage of critical articles that filled the pages of financial publications. Reports of declining performance and internal turmoil sparked a sense of urgency among investors, leading many to withdraw their funds. This reaction exacerbated the decline, feeding a cycle of negativity that was difficult to escape. Within a short span, what was once celebrated had morphed into cautionary tales. The company's name, once synonymous with innovation, became a reminder of the fragility within the financial sector. Trust eroded, leaving behind a landscape marked by disillusionment and loss. In this environment of diminished confidence, new entrants began to emerge within the mutual fund space. These organizations, often equipped with innovative strategies and fresh perspectives, sought to attract investors disenchanted by the failures of established entities. They presented themselves with promises of transparency and accountability, aiming to restore faith in a faltering industry. These newcomers leveraged technology, utilizing digital platforms to streamline investment processes and enhance user experience. With lower fees and the ability to access detailed performance data, they positioned themselves as viable alternatives to traditional firms. The allure of simplicity and clarity resonated with a demographic wary of previous missteps. Market dynamics shifted as these firms gained traction. Their appeal lay not only in their operational efficiencies, but also in their branding, which often emphasized a commitment to ethical investing and social responsibility. This approach attracted a new generation of investors, eager to align their values with their financial decisions. Amidst this influx, existing players faced mounting pressure. The need to adapt became evident as investor preferences evolved. This shift signaled an impending transformation within the sector. The landscape, once dominated by a few key players, was now a mosaic of diverse offerings, each vying for attention in a marketplace characterized by skepticism and renewed hope. Rebranding efforts emerged as a beacon of hope, a strategy to rekindle investor confidence amid shifting market dynamics. This initiative involved a comprehensive overhaul of the company's image, embracing modern aesthetics and employing fresh marketing tactics. New logos and slogans adorned promotional materials, aiming to convey stability and innovation. They sought to reassure potential investors that the organization was evolving, adapting to contemporary financial landscapes. In tandem with these visual changes, a series of seminars and workshops were introduced, featuring industry experts discussing investment strategies and market trends. These sessions provided a platform for engagement, allowing investors to voice concerns and ask questions. A distinct emphasis was placed on transparency, with regular updates on portfolio performance and open communication channels. Despite these efforts, skepticism lingered. The weight of past failures cast a long shadow over the renewed branding. Investors remained cautious, their trust eroded by years of underperformance and mismanagement. The allure of the new marketing campaigns failed to translate into substantial investment inflows. Even as outreach initiatives expanded, the underlying challenges persisted, and confidence remained elusive. The fading company continued to navigate this turbulent environment, striving to balance innovation with the enduring memories of a once prominent legacy overshadowed by its own shortcomings. The struggle to reclaim its former stature proved to be a painstaking journey. The role of economic indicators, particularly inflation and interest rates, became increasingly pivotal in shaping its fate. As these variables fluctuated, they directly influenced investor behavior and market confidence. Rising inflation eroded purchasing power, creating an environment of uncertainty. Investors, wary of diminishing returns, turned their attention away from mutual funds, seeking refuge in more traditional investments such as bonds or real estate. Interest rates in tandem experienced upward momentum. This shift rendered borrowing costs higher, effectively stifling business expansion and consumer spending. The impact on this organization was profound. As rates climbed, capital became scarcer, hindering its ability to innovate or adapt to the evolving financial landscape. Consequently, the mutual fund's performance began to lag, further alienating stakeholders. In this region of economic discontent, the organization's once stalwart reputation began to fray. Clients withdrew their investments, seeking more stable alternatives. Its assets under management dwindled, and the cascading effects of diminishing trust took hold. The intricate interplay of inflation and interest rates, initially perceived as external threats, became internal catalysts for decline. These ruins reflect the broader implications of financial mismanagement amid shifting economic conditions. The echoes of its former success serve as a reminder of the delicate balance required in navigating the financial world, where external pressures can precipitate a swift unraveling. Strategic missteps became evident as poor investment choices and inadequate risk management undermined the foundation of this once prominent entity. They ventured into sectors that appeared lucrative but were fraught with instability, leading to significant losses. Investments in technology startups, while alluring, often resulted in financial drain rather than growth. Promising ventures, once celebrated, turned sour, revealing a lack of due diligence and foresight. These decisions reflected a broader trend of overconfidence, where optimism overshadowed critical analysis. The absence of a comprehensive risk management framework exacerbated these challenges. Lacking robust evaluation processes, they failed to anticipate market shifts and fluctuations. Investments became overconcentrated in particular sectors, leaving the organization vulnerable to external shocks. This region, characterized by volatility, proved unforgiving when economic downturns emerged. The management team, once regarded as visionary, seemed paralyzed by the consequences of their choices. Communication faltered as stakeholders grew increasingly concerned about the trajectory of their investments. discontent brewed among investors who had once placed their trust in this firm's expertise. As losses mounted, the realization of miscalculations settled in. The markets, indifferent to their plight, continued to shift, leaving the fading company grappling with the harsh realities of its strategic errors. They became a case study in how missteps in investment strategy could cascade into broader financial decline. The decline of AltaMIRA coincided with a gradual shift in investor behavior as preferences transitioned toward more versatile options. Exchange-traded funds offered a new model, allowing for greater liquidity and lower expense ratios compared to traditional mutual funds. This region, once bustling with confidence in actively managed portfolios, began to feel the weight of changing attitudes. Investors sought alternatives that promised transparency and real-time trading, attributes that were becoming essential in an increasingly complex market. The foundations of AltaMIRA, built on the belief that expert management could consistently outperform the market, began to erode as individuals recognized the advantages of passive investment strategies. The allure of simplicity and cost-effectiveness drew clients away, leaving the fading company struggling to maintain its foothold. With each passing quarter, inflows into exchange-traded funds surged, while mutual fund sales waned. This migration reflected a broader trend, as financial literacy improved among the general public, empowering individuals to take charge of their investment choices. The decline was not merely a consequence of AltaMIRA internal issues, but rather indicative of a systemic shift in the financial landscape. In boardrooms, discussions turned from proactive strategies to crisis management, as the realization set in that the landscape had irrevocably changed. The once promising future now lay obscured by the shadows of outdated methodologies. Expense ratios provided a crucial lens through which to evaluate the decline of this fading company. Deteriorating performance was exacerbated by high fees that eroded the returns for investors. The structure was not only complex but also opaque, creating confusion among stakeholders. Investors, initially enticed by the promise of growth, began to express dissatisfaction as the costs associated with their investments became increasingly apparent. Management justified the elevated expense ratios by citing research and active management strategies. They argued that their approach warranted the fees, claiming that expertise was essential for navigating market complexities. Yet, as performance faltered, this rationale lost its weight. The gap between the purported value of these services and actual investor returns widened, leading to a growing sense of frustration. As market conditions shifted, competition intensified, and lower-cost alternatives emerged. The once loyal investors began to seek refuge in more transparent, cost-effective mutual funds. This exodus only compounded the financial strain on AltaMIRA, further diminishing its capacity to recover. The burden of maintaining a robust infrastructure in the face of declining assets under management became increasingly unsustainable. The repercussions of these fees extended beyond financial implications. They fostered a lack of trust that would linger in the minds of former clients. The erosion of confidence marked yet another chapter in this company's gradual decline, an irreversible transformation from aspiration to obsolescence. Performance benchmarks reveal a stark contrast between AltaMIRA and industry standards. As market conditions shifted, it became evident that this company struggled to maintain its competitive edge. During its peak, it promised substantial returns to investors, yet the reality unfolded differently. returns fell short against established indices, leaving stakeholders disillusioned. Underperformance reflected not only in financial metrics but also in investor sentiment. Comparisons to leading mutual funds unveiled a troubling narrative. While rivals adapted strategies and embraced innovation, this organization remained stagnant, mired in outdated practices. Portfolio diversification, a critical component for success, was overlooked, resulting in increased vulnerability during market downturns. The absence of a coherent investment strategy exacerbated the situation. Stakeholders observed a lack of transparency in fund management, further eroding trust. Reports detailing asset allocation revealed a misalignment with market trends, leading to diminished returns over time. This misalignment was particularly concerning in a landscape that demanded agility and foresight. The landscape of finance began to shift dramatically with the rise of technology, presenting both challenges and opportunities. Many established entities embraced digital innovation, recognizing its potential to enhance efficiency and customer engagement. In stark contrast, this fading company clung to outdated methodologies, unable to pivot towards the emerging trends that defined modern investment strategies. The introduction of online trading platforms revolutionized the industry, allowing investors direct access to markets with unprecedented ease. This shift rendered traditional mutual fund models increasingly obsolete. It became evident that they had underestimated the growing demand for transparency and immediacy in investment transactions. Failure to adapt to digital trends led to a gradual erosion of investor confidence. As competitors leveraged technology to offer lower fees and enhanced user experiences, the once prominent entity struggled to maintain its relevance. Its reluctance to embrace automation and sophisticated data analytics became a critical flaw, leaving it ill-equipped to compete in a fast-evolving environment. Investor preferences shifted toward agile, tech-savvy firms that prioritized accessibility and user-friendly interfaces. This transition highlighted a stark divide. While some thrived by adopting innovative practices, this institution remained shackled to antiquated systems. The resulting disconnect between expectation and delivery. Crisis management unfolded in the wake of declining assets, revealing the complexities behind leadership's responses. Executives convened in boardrooms, discussing strategies to restore investor confidence. It became evident that a reactive approach dominated the atmosphere, fueled by a sense of urgency rather than a grounded understanding of market fundamentals. Decisions emerged from a place of anxiety, often lacking comprehensive analysis. Communications with stakeholders shifted to damage control, emphasizing reassurances that masked deeper issues. Promises of change resonated, yet the undercurrents of uncertainty persisted. This region, once vibrant with financial promise, now bore witness to a retreating investment base. Reports indicated a steady outflow of capital, exacerbating the deterioration of trust. Leadership attempted to pivot, introducing new products and initiatives. Each announcement aimed to rekindle interest, yet the consistent decline in assets rendered these efforts largely ineffective. The once stalwart brand began to fade, overshadowed by the mounting competitive pressure. Strategies designed to reinvigorate growth seemed to falter, illustrating the chasm between aspiration and reality. Amid the turmoil, internal morale began to wane. Employees grew disheartened as the company shifted focus repeatedly, leading to a fragmented organizational identity. The environment, once characterized by innovation, transformed into one marked by uncertainty and hesitance, capturing the essence of a fading company grappling with its own legacy. Investor sentiment shifted gradually, morphing from cautious optimism to palpable anxiety. This transformation manifested as withdrawal requests surged, each transaction echoing the growing disenchantment with the once promising mutual fund. Confidence diminished as reports of underperformance circulated, leading to a cascading effect on the firm's stability. As individuals sought to reclaim their investments, the pressure on management intensified, forcing them to confront the reality of their dwindling assets. In this atmosphere, a sense of urgency permeated the offices. Executives grappled with strategies to regain trust, often resorting to superficial adjustments rather than addressing the core issues plaguing the organization. Communications aimed at reassuring stakeholders fell flat, their words failing to instill the confidence necessary for recovery. The financial landscape, once a realm of potential, had become a stark reminder of past missteps. In seeking redemption, the fading company endeavored to pivot its investment strategies, yet these efforts often proved too little, too late. The reliance on historical performance metrics, once a bedrock of their appeal, no longer resonated with anxious investors. The withdrawals accelerated, and as funds drained, the remaining assets reflected not just a financial decline, but an existential crisis. A once thriving venture now teetered on the brink, its legacy threatened by the very investors it had sought to serve. Communication faltered as uncertainty loomed over the fading company. Shareholders, once confident in their investments, found themselves grappling with anxiety and mistrust. Reports became less frequent, and when delivered, they often contained vague language that failed to address the underlying concerns. The absence of clarity bred suspicion among investors, who questioned the leadership's competence and commitment to transparency. This region, once a hub of financial optimism, now echoed with discontent. Stakeholders expressed frustration at the lack of straightforward updates regarding performance and strategy. Instead of fostering a sense of partnership, the leadership's guarded approach alienated those they relied on for support. It became increasingly evident that trust, an essential pillar of any investment venture, had eroded. Efforts to rectify this situation came too late. Town halls and formal meetings were organized, yet the damage had already been done. Those in attendance, seeking reassurance, instead encountered a parade of contradictions and half-truths. The rhetoric of resilience rang hollow against the backdrop of dwindling assets and rising discontent. With each passing month, the gulf widened. As transparency remained elusive, shareholders began to retreat. Their hesitation to reinvest reflected deeper issues within the organization, leaving it adrift in a sea of uncertainty, unable to regain the trust it had so critically lost. The absence of confidence within the ranks prompted significant departures, further destabilizing the already precarious structure. Key personnel, once deemed essential to the organization's vision, began to seek opportunities elsewhere. This exodus created a vacuum of expertise, leaving critical positions unfilled and knowledge gaps that would prove difficult to bridge. Leadership, in particular, experienced a seismic shift as seasoned executives opted for more stable environments. Their departure not only stripped the organization of strategic direction, but also sent a troubling signal to investors and stakeholders, further aggravating the prevailing atmosphere of uncertainty. The loss of these figures, who had shaped the organization's early successes, left a void that junior staff were ill-equipped to fill. As the remaining team struggled to maintain operations, morale began to wane. The culture that once fostered innovation and collaboration succumbed to a pervasive sense of unease and pessimism. Communication faltered, and the once clear vision became obscured by confusion and disarray. The ramifications of these departures extended beyond internal dynamics. External perception shifted, with media narratives framing the organization as a sinking ship. This negative portrayal further alienated potential investors, eroding any remaining confidence in its ability to recover. The manifestations of these departures echoed throughout the industry, marking a critical turning point in the company's decline. The diminished oversight from the board began to unravel the company's foundational stability. Governance took on a passive role, with members often prioritizing personal interests over fiduciary responsibilities. This absence of active engagement allowed decisions to be made without the rigorous scrutiny necessary for a thriving enterprise. Misalignment between executive leadership and board expectations emerged, signaling the onset of strategic disarray. Accountability was notably absent during pivotal moments of decision-making. As investment strategies faltered, the board did not intervene. Instead, they appeared to operate under the assumption that historical success would continue unchallenged. The lack of rigorous oversight led to a culture where risk was underestimated and complacency thrived. Key stakeholders became increasingly concerned, yet their voices remained unheeded. The repercussions of this governance failure were profound. Strategic initiatives, once promising, fell victim to poor execution without corrective measures. Financial reports reflected the growing discontent, revealing a divergence from industry benchmarks. Investors, once loyal, began to withdraw their support, sensing the instability that governance issues had wrought upon the organization. In time, the board's inability to adapt to evolving market conditions contributed to a widening chasm between aspiration and reality. This region, once a beacon of investment opportunity, now bore the marks of governance neglect, signaling the quiet unraveling of what was once regarded as a formidable player in the financial landscape. Analyzing the marketing campaigns reveals a systematic misalignment with the evolving expectations of investors. Initial efforts showcased a promise of growth and stability, utilizing optimistic slogans and bold imagery. This approach, however, faltered as market conditions shifted. The messaging failed to adapt, remaining entrenched in a bygone era of confidence that no longer resonated with a more discerning audience. The campaigns increasingly relied on outdated demographics, overlooking the emergence of younger, more tech-savvy investors. This disconnect fostered a sense of alienation, as potential clients sought platforms that embraced innovation and transparency. The promotional materials, once vibrant and engaging, became stale and formulaic, lacking the dynamism necessary to capture attention in a rapidly changing marketplace. Attention to digital channels was minimal, leaving a void that competitors swiftly filled with engaging content and interactive experiences. It became evident that the marketing strategies did not reflect the needs and desires of the target demographic. A failure to incorporate feedback mechanisms further exacerbated the situation, leaving the organization unaware of the growing discontent among its clientele. As these campaigns continued to unfold amidst a backdrop of declining trust, the disconnect between the brand and its audience widened. The once promising image of the company faded, mirroring the overall decline that enveloped the institution. Investor education played a critical role in the downfall of this institution. Many individuals entered the market, drawn by the allure of mutual funds without grasping their complexities. Misunderstanding the foundational principles of these financial instruments became widespread. This lack of comprehension led to misguided expectations, often resulting in disappointment. Communication strategies employed by the company were insufficient. Materials provided to potential investors lacked clarity, failing to demystify essential concepts. As intricate details remained obscured, apprehension replaced confidence. Many investors approached mutual funds with a transactional mindset rather than recognizing them as long-term investments requiring consideration. In this environment, the allure of immediate returns proved seductive. Promises of high yields obscured the realities of market volatility and risk. Misinterpretations of the role of diversification in mitigating losses further compounded the situation. Consequently, a significant number of individuals withdrew their investments during downturns, exacerbating the company's financial instability. The absence of proactive educational initiatives left a void, which only deepened the disconnect between investor expectations and the actual performance of funds. This disconnect echoed throughout the industry, reinforcing skepticism toward mutual funds as a viable investment vehicle. As understanding waned, so too did trust, leading to a gradual erosion of the once solid foundation upon which the company was built. Communication faltered, and with it, the relationship between the company and its investors suffered. Instances of poor customer service began to compound the discontent. Each interaction, marked by unhelpful responses and extended wait times, chipped away at the confidence that had once characterized investor sentiment. Investors seeking clarity and support were met with indifference, fostering a sense of abandonment. This region of financial services, once bustling with activity, began to feel the weight of disillusionment. As queries went unanswered, frustrations mounted. Investors found solace in alternatives, slowly shifting their assets away from the fading company. Loyalty, once a hallmark of its reputation, began to dissolve. The repercussions of neglecting customer care extended beyond individual discontent. As word spread, potential clients hesitated to engage, wary of the experiences shared by others. Trust became a scarce commodity in an industry reliant on relationships. In tandem with the decline in loyalty, the financial metrics reflected this unsettling trend. Assets under management dwindled, and revenue projections faltered. The once promising future now appeared bleak, painted in shades of uncertainty. With investor trust evaporating and customer service failures compounding, the company faced an uphill battle. The landscape, once vibrant with opportunity, transformed into a stark reminder of the consequences of neglecting foundational principles. The decade of the 1990s witnessed a market boom characterized by rapid technological advancements and economic growth. This era presented numerous opportunities for recovery, yet the fading company remained anchored by its past missteps. Investment in innovative strategies and adaptive practices became crucial in this shifting environment. Instead of seizing these moments, leadership opted for a conservative approach, favoring stability over necessary transformation. This resistance to change contributed significantly to its decline. Competitors, driven by a willingness to embrace emerging trends, flourished in the growing market. The once promising mutual fund, instead of evolving, clung to outdated models, unable to attract new investors. The allure of high returns from technology stocks captivated many, leaving it trailing behind. As new firms emerged, energized by fresh ideas and strategic vision, the fading company found itself increasingly marginalized. Marketing efforts failed to resonate, leading to a slow erosion of investor confidence. The disconnect between their offerings and market expectations widened, fueling discontent among stakeholders. An era defined by growth and potential turned into a backdrop of missed opportunities. The lack of proactive measures and response to market signals became apparent, sealing its fate. This period, ripe with possibilities, instead marked the beginning of an inevitable decline, as the once prominent entity faded into obscurity. The transition in investment strategies began to take shape as the financial landscape evolved. Traditional mutual funds, once the cornerstone of investment portfolios, faced increasing scrutiny amid a growing preference for lower-cost alternatives. Investors began to gravitate towards index funds, drawn by their simplicity and efficiency. This shift reflected a broader understanding of market dynamics and a desire for transparency. Index funds offered a straightforward approach, allowing individuals to invest in a wide array of stocks while minimizing expenses. The allure of passive management contrasted sharply with the actively managed mutual funds, which often underperformed relative to benchmarks. As more investors recognized this discrepancy, the tide turned decisively. This region of the financial market witnessed a gradual erosion of trust in traditional mutual fund strategies. As capital flowed away, offerings became less competitive, leading to diminished returns and increased fees. The realization that many actively managed funds failed to consistently outperform their index counterparts compounded the situation, further fueling the transition. Consequently, the fading company struggled to adapt to these new demands. It found itself unable to innovate or reduce costs at a pace that matched the rapidly changing preferences of investors. The once thriving landscape of mutual funds began to resemble a relic of the past, overshadowed by the ascendant prominence of index funds. Regulatory changes introduced a complex framework that impacted mutual funds significantly. New legislation sought to enhance transparency and protect investors, yet it also imposed constraints that many firms struggled to navigate. Compliance requirements multiplied, compelling these firms to allocate substantial resources to legal and administrative functions, diverting attention from core investment strategies. In this climate, the burden of adhering to evolving regulations weighed heavily on many fund managers. They faced an increasingly intricate regulatory landscape, which demanded rigorous reporting and disclosure practices. This shift led to a gradual erosion of the competitive edge that had distinguished successful firms. Strategies that once thrived under looser oversight now faltered under scrutiny. The imposition of fiduciary standards required managers to prioritize client interests, further complicating operational flexibility. This expectation fundamentally altered the relationship between fund managers and their clients, creating an environment fraught with mistrust. As clients became more discerning, their preference for lower-cost options intensified, amplifying the challenge for traditional mutual funds. These developments prompted a gradual withdrawal of investment from traditional funds, as many investors migrated towards index funds that offered simplicity and reduced fees. The regulatory burden, which was intended to safeguard investor interests, inadvertently contributed to the decline of an industry once perceived as a cornerstone of personal finance. In the aftermath, the fading company struggled to adapt to its new reality. The importance of performance reporting became a pressing concern as it became clear that misleading metrics played a significant role in the company's decline. Investors relied heavily on performance data to make informed decisions, yet the figures often painted a distorted picture. Returns, calculated in isolation, obscured the underlying risks and volatility. In this environment, the nuances of performance reporting were frequently overlooked, leading to misguided confidence among stakeholders. Data presentation became a double-edged sword. While it was intended to convey positive growth, it often failed to account for the broader market context. Investors were lured by attractive annualized returns that masked fluctuations. These reports neglected to disclose the potential for loss during downturns, creating a false sense of security. The allure of high returns became a siren call, drawing in capital despite the inherent instability. The mismatched expectations further deepened the chasm between the firm and its clientele. As the truth behind the numbers emerged, trust eroded. Stakeholders began to question the integrity of the figures, leading to an atmosphere of uncertainty. The revelation of discrepancies in performance reporting marked a pivotal moment where the once loyal investors began to withdraw their support. The fabric of the company frayed under the weight of disillusionment, leaving behind a legacy marred by mistrust and misrepresentation. Institutional investors played a pivotal role in shaping the trajectory of AltaMIRA. Their initial enthusiasm provided the necessary capital that propelled the firm into the competitive landscape of mutual funds. This influx of funds fostered an atmosphere of growth, yet it also introduced a level of scrutiny that the company struggled to manage effectively. As expectations for performance rose, so did the pressure on its management to deliver returns. In this environment, decisions became increasingly short-sighted, prioritizing immediate gains over sustainable growth. The once promising strategies began to falter as institutional investors demanded transparency and accountability. Discontent grew as the portfolio underperformed relative to market benchmarks, leading to heightened skepticism about the firm's viability. The disconnect between management's vision and the expectations of these large stakeholders became evident. The erosion of trust was gradual but palpable. Withdrawals commenced as institutional investors reevaluated their positions, prompting a cascade of further uncertainty. These actions not only destabilized the company's financial foundation, but also signaled to the broader market that AltaMIRA was in decline. The once robust support system began to unravel, leaving behind a stark reminder of misaligned priorities and the perils of over-reliance on institutional backing. This shift highlighted the fragility of its operations in a rapidly evolving financial landscape. The decline in assets under management revealed critical vulnerabilities within the organization. Once a leader in the mutual fund sector, it began to experience significant withdrawals as investors sought alternatives that offered more promising returns. This regressive trend was marked by a gradual but steady erosion of client confidence, leading to a cumulative decrease that spanned several quarters. Data illustrated a stark contrast to earlier performance benchmarks. At its peak, the firm managed assets exceeding $5 billion, cultivated through a blend of strategic marketing and market positioning. By the end of the first decade, however, those numbers dwindled to less than $2 billion. This contraction was not merely a reflection of market conditions. it was indicative of deeper structural problems. The absence of innovative investment strategies and the failure to adapt to shifting consumer preferences left it vulnerable. Competitors capitalized on this stagnation, frequently launching products that resonated more with evolving investor demographics. The traditional approaches employed by the firm, once considered stable, became increasingly outdated, leading to further declines in market share. Investors shifted their focus toward firms promising higher returns and better management fees. The results were telling. This region of the financial landscape, once vibrant with promise, now bore witness to a gradual but inevitable decline, underscoring the unforgiving nature of the industry. The decision to liquidate the fund marked a significant turning point in its troubled history. Shareholders, once optimistic about their investments, found themselves grappling with the reality of diminishing returns and declining market confidence. As the management team convened to assess the situation, it became evident that continued operation would not only threaten their credibility, but also deplete the remaining assets. The atmosphere within the boardroom was heavy with resignation. Financial forecasts painted a grim picture, revealing a stark contrast to the initial projections that had fueled enthusiasm in its inception. Stakeholders were informed that the fund had struggled to compete with emerging investment platforms that offered more attractive options. The once competitive edge had eroded, leaving investors disillusioned. In these final days, the communication with clients shifted from optimism to transparency. The decision to liquidate was positioned as a necessary measure to protect what little value remained. Notices were dispatched, outlining the plan process and the timeline for the disbursement of remaining assets. Each notification served as a reminder of aspirations unfulfilled and dreams deferred. The legal landscape surrounding the fading company became increasingly fraught with complications. Shareholders expressed their discontent, leading to a series of lawsuits that accused the leadership of mismanagement and negligence. Allegations emerged regarding misleading financial reports and unauthorized trading practices, further eroding trust in the once promising organization. These disputes were layered with a sense of urgency as stakeholders sought restitution for their losses. Settlements became a common resolution, yet they did little to restore confidence. Each agreement represented not just a financial transaction, but a quiet acknowledgement of the company's descent into turmoil. Legal fees mounted, diverting resources away from potential recovery efforts. The implications of these legal troubles spread through the organization, impacting employee morale. Those who had once believed in the mission found themselves grappling with uncertainty. As the lawsuits progressed, the repercussions were felt beyond the boardroom. They seeped into the fabric of the company culture, creating an environment of anxiety and doubt. Regulatory scrutiny intensified, and the organization faced investigations that further complicated its standing in the financial community. The cycle of litigation became a relentless shadow, obscuring any potential recovery and stifling innovative initiatives. In this region, the weight of legal challenges signified a pivotal moment in the narrative of decline, highlighting the fragility of trust within the financial realm. Investors observed the unfolding situation with a mix of concern and contemplation. The disintegration of AltaMIRA served as a stark reminder of the underlying vulnerabilities inherent in mutual fund investments. Decision-making processes came under scrutiny, revealing the necessity for enhanced due diligence. the fragility of perceived stability became evident, prompting a shift in investor sentiment across the sector. In this context, the importance of transparency emerged as a critical lesson. Stakeholders began to demand clearer communication regarding fund operations and the risks associated with their investments. This call for accountability marked a turning point in investor expectations, as trust became an increasingly precious commodity. The era of blind faith in established entities faded, replaced by a cautious approach that valued transparency over reputation. Alongside transparency, diversification took on renewed significance. Observers recognized that reliance on a single entity for financial growth posed substantial risks. This realization led to a strategic reallocation of assets, with investors favoring a broader spread across various sectors and instruments. The aftermath created a ripple effect throughout the organization. Employees experienced an unsettling shift in their daily routines, marked by uncertainty and apprehension. Many found themselves grappling with the implications of a faltering company, as job security became increasingly precarious. Morale diminished, overshadowed by the specter of layoffs and restructuring. Stakeholders who once held confidence in the organization faced a stark reassessment of their investments. The decline in performance prompted a reevaluation of the trust placed in this firm. Shareholders began to voice their concerns, demanding transparency and accountability. Meetings became more frequent, as executives were pressed to articulate a coherent recovery strategy. In this environment, innovation stagnated. Resources that could have been utilized for growth were redirected to address immediate financial pressures. The once vibrant culture transformed into one defined by caution and hesitance. Ideas that flourished in earlier days were stifled under the weight of scrutiny and diminished funding. Clients, too, were not immune to the impact. They began to explore alternatives, wary of placing their faith in a company struggling to maintain its footing. The market observed these developments, leading to a cascading effect on brand reputation. Trust eroded, leaving a void that would be challenging to fill as the fading company sought to navigate the turbulent waters of recovery. The lingering effects of AltaMIRA decline extended far beyond the confines of its corporate structure. This chapter in financial history serves as a cautionary tale, illustrating the fragility of trust and the repercussions of mismanagement. Lessons drawn from its downfall resonate through boardrooms and investment firms alike, highlighting the importance of transparency and accountability in maintaining client relationships. Management's inability to adapt to a rapidly evolving market left a void not easily filled by competitors. Stakeholders, once loyal, dispersed into a fragmented landscape, seeking assurance elsewhere. The repercussions of misplaced confidence echoed through financial markets, leading to increased scrutiny of mutual fund operations. These events underscored the necessity for regulatory frameworks designed to safeguard investors, emphasizing the need for clear communication and ethical practices in finance. The remnants of AltaMIRA legacy can be observed in revised investment strategies and enhanced oversight protocols that emerged in response to its failure. This period prompted a reevaluation of risk management practices, urging firms to prioritize investor interests above all else. The ripple effect of its collapse transformed the mutual fund industry, fostering a culture of diligence and respect for fiduciary responsibilities. In the end, the story of AltaMIRA remains a poignant reminder of the delicate balance between ambition and responsibility within the financial realm. The decline of AltaMIRA serves as a pivotal case study, illustrating the vulnerabilities inherent in mutual funds. Other notable failures have similarly unmasked systemic weaknesses. The abrupt downfall of the Greenstone Fund in the late 1990s underscores the perils of unchecked growth. Rapid asset accumulation led to insufficient risk management protocols. In another instance, the Horizon Fund faced scrutiny for its lack of transparency and accountability. Misleading performance reports bred distrust, culminating in a significant withdrawal of capital that precipitated its decline. Investor confidence eroded as oversight faltered, leading to catastrophic consequences. The Northern Equity Fund experienced a similar fate, plagued by mounting operational inefficiencies and an inability to adapt to shifting market conditions. Its management team, once revered for their expertise, faltered under pressure, revealing the fragility of perceived stability in the face of adversity. These examples reveal a pattern. Each failure, while unique, showcases a common thread of neglecting fiduciary duties and the vital importance of due diligence. They serve as cautionary tales, emphasizing that success in this sector is often as precarious as it is sought after. The lessons gleaned from these mutual funds linger, echoing within the broader financial landscape. This legacy shapes the ongoing evolution of investment practices. New regulations emerged in the wake of AltaMIRA decline, addressing the vulnerabilities exposed during its operation. These revisions sought to restore investor confidence, reflecting a collective acknowledgement of the need for stronger oversight. The introduction of transparency mandates became a cornerstone of the new regulatory framework. Investment firms were required to disclose more detailed information regarding fund performance and fees, illuminating aspects that had previously been obscured. The establishment of fiduciary standards for financial advisors marked another significant alteration. Advisors were now obligated to prioritize clients' interests above their own, a shift that aimed to mitigate the conflicts of interest that had been rampant within the industry. This adjustment underscored a growing recognition of the need for ethical responsibility in financial advice. In addition, the regulatory bodies increased scrutiny of marketing practices. The intention was to prevent misleading claims and to ensure that potential investors received accurate representations of investment risks. This shift in regulatory philosophy signaled a broader understanding of the importance of protecting the average investor from the pitfalls that had contributed to AltaMIRA fall. These changes formed a new landscape for mutual funds and investment strategies. Adjustments in regulation facilitated a cautious optimism, reflecting a commitment to fostering a more stable environment for investment. In this evolving framework, the lessons from AltaMIRA remained a subtle yet persistent influence. The shifting landscape of mutual funds was profoundly shaped by the lessons gleaned from AltaMIRA decline. This once prominent entity began to reveal the vulnerabilities that lurked within traditional investment strategies. As investors grew wary of high management fees and lackluster performance, the demand for transparency surged. Companies in this region began to adapt by lowering costs, prioritizing investor education, and embracing technology in a bid to restore confidence. The emergence of passive investment strategies gained momentum, as many sought to avoid the pitfalls that had ensnared AltaMIRA. Exchange-traded funds entered the scene, providing a more cost-effective and flexible alternative. With this transformation, the industry witnessed a shift toward data-driven decision-making, emphasizing risk assessment and diversification. Innovators introduced new methodologies, allowing for a clearer understanding of fund performance and alignment with investor objectives. Legacy firms found themselves at a crossroads, grappling with the need to reinvent their approaches or face obsolescence. This environment fostered a wave of new entrants, eager to capitalize on the dissatisfaction that lingered in the wake of AltaMIRA collapse. As these newcomers flourished, traditional players were compelled to evolve, marking an essential pivot in the mutual fund industry. The echoes of AltaMIRA failure served as a crucial reminder of the importance of adaptability in a rapidly changing financial landscape. Market volatility exerted a significant influence on fund performance, acting as both a challenge and a catalyst for decision-making within AltaMIRA. Fluctuating economic conditions led to unpredictable investor behavior, often resulting in a reluctance to commit capital. This hesitance manifested in dwindling assets under management and diminishing returns. As financial markets oscillated between peaks and troughs, the company's strategies appeared increasingly misaligned with the prevailing climate. Tactical shifts aimed at mitigating risks were sometimes too late to reverse the trajectory of decline. The inability to navigate this volatility with precision left the fund exposed to the wider market's whims. Investor confidence waned, creating a cycle of withdrawal that exacerbated the fund's struggles. These dynamics illuminated the critical interplay between external market factors and internal management practices. The need for timely and effective responses to market signals became evident, yet AltaMIRA efforts fell short. It struggled not only to adapt its strategies, but also to communicate its vision effectively to stakeholders. Amidst this backdrop, the specter of competition lingered. Other funds, nimble and attuned to the fluctuations of the marketplace, capitalized on opportunities that escaped AltaMIRA. The fading company, once a beacon of financial promise, began to erode the trust investors had placed in it. Confidence dwindled as performance reports revealed persistent underperformance. Investors, lured by marketing campaigns and an assurance of stability, found themselves grappling with feelings of betrayal. The very foundation of their financial planning was shifting beneath their feet. This region of mutual fund investments had once thrived on the assurance that their assets were being managed with diligence. Frequent communication and reassurances from AltaMIRA executives, once seen as a strength, transformed into hollow echoes of a bygone era. Dismayed stakeholders watched as their financial aspirations crumbled, their trust replaced by unease. An emotional toll emerged, manifesting in skepticism towards similar investment vehicles. Investors began to question the integrity of the financial system, worried that their hard-earned savings might be vulnerable to mismanagement. The once promising narrative of mutual funds shifted into a cautionary tale, fostering an environment where trust was a rare commodity. The psychological impact was profound as individuals processed their losses and reassessed their financial futures. The trust that had been built over years evaporated, leading to a pervasive sense of disillusionment. In the aftermath, the scars of betrayal lingered long after the company's decline, reshaping perceptions of financial security. The evolution of mutual fund marketing, particularly in the wake of AltaMIRA failure, reveals profound lessons about consumer trust and brand integrity. Strategies that once thrived in the glow of rising markets fell into disrepair as skepticism permeated the industry. The once prominent firm, known for its aggressive marketing campaigns, illustrated the perils of prioritizing style over substance. Overly optimistic projections and flashy advertisements did little to conceal the underlying vulnerabilities that, in this new climate, relationship building became paramount. Transparency and authenticity emerged as essential tenets, replacing the previous reliance on glossy brochures and lofty promises. Investors began to seek assurances, demanding clear communication regarding risks and rewards. The landscape shifted toward educational initiatives, fostering an informed clientele that prioritized understanding over blind allegiance. This region of the financial sector witnessed the rise of digital platforms, allowing for direct engagement between firms and consumers. Personalization of services became a focal point, with data-driven insights guiding tailored offerings to meet individual needs. The remnants of AltaMIRA serve as a cautionary tale, reminding stakeholders that a robust marketing approach must be anchored in genuine value delivery. As mutual funds adapt to these evolving expectations, the lessons from that faded company lay a foundation for future resilience in an ever-changing marketplace. The legacy of AltaMIRA extends beyond its operational failures, marking a significant chapter in the evolution of financial education and awareness. This once prominent firm served as both a pioneer and a cautionary tale, illuminating the complexities of investment strategies during its brief ascent. It highlighted the necessity of consumer understanding in an increasingly intricate financial landscape. In this region of the market, AltaMIRA introduced innovative concepts aimed at demystifying investment for the average individual. They sought to promote knowledge sharing through seminars and educational materials, recognizing the importance of informed investors. This initiative aimed to empower clients, cultivating a generation more adept at navigating financial waters. Yet, despite these efforts, the firm struggled to maintain its footing as market dynamics shifted. The repercussions of AltaMIRA decline rippled through the industry, prompting a reevaluation of educational approaches. Financial literacy became a focal point, revealing a glaring gap in understanding among investors. In the wake of its downfall, other institutions began to incorporate comprehensive educational resources into their offerings. Such adaptations aimed to ensure that investors could make sound decisions in the face of uncertainty. The decline of this fading company. The decline of this fading company coincided with the rise of social media, which began to reshape investor behavior in unprecedented ways. Accessible platforms allowed individuals to share opinions, strategies, and experiences, creating a collective consciousness that influenced market dynamics. As these channels flourished, they transformed the landscape of investment decision-making. Information became instantaneous, democratizing access to data and insights that were once the domain of financial professionals. This shift enabled a new breed of investor, often driven by trends and affiliations rather than traditional analysis. Emotional reactions and herd mentality began to dictate trading patterns, sometimes overshadowing the rationale of sound investment practices. Investors increasingly relied on social media for guidance, often prioritizing viral content over empirical research. This led to erratic buying and selling behaviors, which could create volatility that undermined the stability of established firms. The fading company struggled to adapt to this new environment, where trust and credibility were increasingly tied to online personas rather than institutional prestige. As discussions proliferated in digital spaces, traditional financial institutions found themselves grappling with the implications of a rapidly evolving marketplace. The inability to navigate this transition contributed to the erosion of investor confidence and the gradual decline of AltaMIRA reputation. Mismanagement of resources became apparent as it struggled to adapt to the rapidly changing landscape of investment strategies. This region of financial management witnessed a significant shift in how funds were perceived, particularly in light of AltaMIRA shortcomings. The fallout from its decline prompted a reevaluation among investors, leading to a cautious approach regarding mutual funds. The ripple effects of this failure extended into future fund management practices. Lessons learned from AltaMIRA experience influenced new frameworks, emphasizing transparency, risk management, and investor communication. Fund managers began to prioritize diversified portfolios, recognizing the importance of resilience against market fluctuations. This shift fostered a culture of accountability, encouraging firms to adopt more stringent regulatory measures. Emerging fund management entities sought to distinguish themselves by incorporating technology and data analytics, ensuring a more responsive investment strategy. The emphasis on performance metrics and investor engagement became paramount as firms aimed to rebuild trust. The legacy of AltaMIRA decline served as a cautionary tale, reminding stakeholders of the fragility within the financial sector. In the years following this collapse, the focus on ethical practices and sustainability within fund management gained traction, driven by an awareness of the repercussions associated with neglecting investor interests. This evolution indicated a collective commitment to nurturing a healthier investment environment. The significance of risk assessment in investment strategies cannot be overstated. As the landscape of the financial market evolved, it became increasingly clear that understanding potential pitfalls was essential for sustaining growth. Investors began to recognize that a mere pursuit of profit was insufficient. A comprehensive analysis of risk factors was imperative. This awareness transformed the approach to portfolio management, shifting the emphasis toward a more balanced allocation of assets. Strategies developed during this period emphasized diversification as a means to mitigate exposure to market volatility. By spreading investments across various sectors and asset classes, firms sought to shield themselves from the adverse effects of economic downturns. This proactive stance toward risk management became a cornerstone of sound investment practices, allowing firms to navigate turbulent financial waters with greater resilience. In the realm of mutual funds, the importance of risk assessment gained further prominence. Investors began to demand greater transparency regarding the underlying risks associated with their investments. Fund managers, in turn, were compelled to adopt more rigorous analytical tools and methodologies to evaluate potential hazards. This shift fostered an environment where informed decision-making supplanted speculative impulses, leading to a more stable investment climate. The lessons learned during this period laid the groundwork for future investment practices, underscoring the essential nature of risk assessment in cultivating enduring financial strategies. Investors began to recognize the importance of financial literacy as a safeguard against the pitfalls of uninformed decision-making. This newfound awareness manifested in the demand for educational resources, as individuals sought to enhance their understanding of market dynamics and investment strategies. Institutions responded by developing comprehensive curricula aimed at demystifying complex financial concepts. Workshops and seminars became commonplace, fostering a culture of continuous learning and adaptation. These initiatives empowered investors to analyze data critically, interpret trends, and evaluate risks with greater precision. Enhanced financial literacy reduced the allure of speculative behavior, encouraging a more disciplined, analytical approach to investment. As communities embraced this educational shift, it became evident that informed decision-making was not solely an individual pursuit, but a collective endeavor. Collaborative efforts emerged, creating networks where individuals could share knowledge and experiences, further reinforcing the foundation of sound financial practices. This transformation in mindset gradually permeated throughout the investment landscape, ensuring that future generations of investors would approach markets with a keen understanding of the inherent risks. The consequences of past failures served as a poignant reminder, urging a commitment to lifelong learning and responsible investing. In this evolving environment, financial literacy proved to be an indispensable tool, effectively mitigating the potential for recurring crises in the world of mutual funds. A significant focus shifted towards rebuilding trust in the wake of AltaMIRA collapse. Trust, once fractured, required careful reconstruction through transparency and accountability. Industry leaders recognized the necessity of demonstrating a commitment to ethical practices and clearer communication. New regulations emerged, designed to protect investors from misleading information and practices that had previously contributed to the decline. Encouragingly, firms began to adopt stringent compliance measures, emphasizing the importance of full disclosure. This commitment aimed to foster a renewed sense of security among investors who had felt betrayed. Education programs proliferated, targeting both financial professionals and the general public. These initiatives sought to empower individuals with knowledge, enabling them to make informed decisions and navigate the complexities of mutual funds. Investment firms sought to redefine their identities, moving away from past missteps. They emphasized customer service and proactive engagement. This approach aimed to create lasting relationships built on trust rather than mere transactions. Surveys conducted in this region indicated a gradual recovery of investor confidence, revealing a willingness to reconsider mutual funds as viable investment tools. Despite the challenges faced, the industry demonstrated resilience. By prioritizing ethical standards, fostering educational initiatives, and enhancing communication, it began to reshape perceptions. The long path to recovery illustrated a collective commitment to learning from the past, ensuring a more stable future for investors and the mutual fund landscape. The transformation of investor expectations marked a significant shift in the financial landscape. New philosophies began to emerge, driven by a desire for transparency and accountability. Investors sought not only returns, but also a deeper understanding of the underlying mechanisms that govern their investments. This evolution led to a more informed and discerning clientele, unwilling to accept vague assurances. In this region, the demand for clarity prompted financial institutions to adapt their practices. They introduced educational initiatives aimed at demystifying complex financial products, fostering a culture of informed participation. The once opaque realm of mutual funds became increasingly accessible as firms worked diligently to provide comprehensive information about fees, risks, and performance metrics. These changes were not merely superficial. They reflected a fundamental reevaluation of trust between investors and financial advisors. A new paradigm emerged, one that emphasized collaboration rather than mere transaction. Investors began to prioritize funds aligned with their values, seeking those that embraced sustainable practices and ethical considerations. The impact rippled through the industry, forcing firms to reassess their strategies in order to remain competitive. This evolution paved the way for innovative products and services designed to cater to shifting preferences. What financial analysts learned from AltaMIRA reveals critical insights into the fragile nature of financial institutions. Initial optimism surrounding the mutual fund was rooted in a well-intentioned premise of democratizing investing. As the company expanded, it became apparent that its growth strategies lacked sustainable foundations. Analysts noted a pattern of misaligned objectives, where short-term gains overshadowed long-term stability. The decision to prioritize aggressive marketing over rigorous risk assessment proved detrimental. Funds that were once lauded for their diversity became vulnerable to market volatility, leaving investors exposed. This miscalculation led to a cascade of investor withdrawals and a notable decline in capital. In examining the failures, analysts emphasized the importance of adaptive leadership and market responsiveness. A disconnect between management decisions and investor sentiments was glaring, underscoring the need for clear communication and alignment of goals. The inability to pivot in a shifting economic landscape highlighted a failure to recognize emerging trends, such as the rise of digital platforms. The aftermath revealed a stark reality. Trust, once a cornerstone of the financial services sector, eroded quickly. Observers noted that the lessons learned from AltaMIRA extend beyond mere financial metrics, serving as a cautionary tale about the enduring need for integrity and foresight in an industry marked by rapid change. Innovations began to surface in response to the decline of this early mutual fund. The landscape shifted as financial experts sought new strategies to restore confidence and relevance in a volatile market. Emphasis turned toward transparency, with an increasing number of funds adopting clearer reporting practices and enhanced communication with investors. This commitment to openness aimed to rebuild trust, which had been eroded by previous failures. Advisors shifted their focus to technology, implementing sophisticated algorithms and data analytics to refine investment strategies. These tools allowed for real-time assessments of market trends, providing a more agile response to changing conditions. The development of robo-advisors also emerged, democratizing access to investment management for a broader segment of the population. Increasingly, funds began to explore sustainable investing, recognizing a growing demand for ethical considerations in financial decisions. This led to the rise of socially responsible funds that prioritized environmental, social, and governance factors, inviting a new generation of investors. As the industry evolved, educational initiatives gained traction, equipping investors with the knowledge necessary to navigate the complexities of modern investments. These efforts reflected a collective understanding that the past mistakes of the fading company should serve as a foundation for future growth, blending tradition with innovation to foster a resilient mutual fund landscape. A profound shift in the investment management landscape emerged as ethical standards gained prominence. This region, once characterized by unchecked ambition, began to recognize that trust served as a cornerstone for sustainable growth. Investors sought assurance that their assets were being managed not only for profit, but with a commitment to integrity and transparency. The emphasis on ethical practices became a guiding principle for firms aspiring to regain their reputations. These standards, often codified into formal frameworks, delineated acceptable behaviors and set benchmarks for accountability. They prompted a reevaluation of how firms interacted with clients, regulators, and the broader community. As firms adopted these ethical guidelines, they paved the way for an environment where informed decision-making flourished. Investors, once skeptical and hesitant, began to re-engage, reassured by the presence of robust governance structures. This re-engagement signaled a potential resurgence, with capital flowing back into previously tarnished entities. In this evolving context, investment management was no longer merely a transactional endeavor. It transformed into a commitment to stewardship, where the focus shifted toward long-term performance, responsible investing, and the societal impact of financial decisions. The landscape gradually adapted, reflecting a newfound respect for ethical standards, laying the groundwork for a more principled approach to investment management. Legacy fund structures emerged as a direct response to the shifting tides of ethical investment standards. AltaMIRA influence reverberated through the corridors of financial institutions, guiding future offerings toward more transparent and accountable frameworks. This period saw a departure from opaque practices, with managers recognizing the necessity of clear communication regarding fund objectives and investment strategies. The commitment to ethical management began to manifest in the formation of funds that prioritized social responsibility alongside profitability. New structures emphasized diversification and risk management, ensuring that investors were armed with comprehensive insights into their portfolios. The movement towards sustainable investing gained momentum, a legacy rooted in the lessons learned from past missteps. Investment firms began to adopt a more holistic approach, integrating environmental, social, and governance criteria into their assessment processes. These changes were not merely cosmetic. They indicated a fundamental shift in how investment value was perceived. Trust and integrity became paramount, reshaping the investor landscape. As these advancements unfolded, the legacy of AltaMIRA solidified into a framework that other entities aspired to replicate. It established a benchmark for accountability, fostering a culture of vigilance and ethical stewardship. This evolution in mutual fund offerings streamlined investor expectations. Strategies for resilience emerged in response to the lessons learned from the fading company. This region witnessed a shift in the approach to mutual fund creation, with a focus on transparency and accountability. New fund managers recognized the importance of clear communication with investors, fostering trust that had been eroded by previous mismanagement. These emerging entities prioritized diversified portfolios, aiming to mitigate risks associated with concentrated investments. By embracing a broader range of asset classes, they sought to insulate themselves from market volatility. Innovative fee structures also took center stage, moving away from the high expense ratios that had plagued early counterparts. This shift aimed to align interests more closely with those of the investors. Enhanced technology played a vital role in navigating the changing landscape. Advanced analytics allowed for more informed decision-making, enabling fund managers to adapt to the ever-evolving market conditions. Digital platforms facilitated greater accessibility, empowering individual investors to engage with their investments in ways previously unavailable. Educational initiatives became essential, equipping both fund managers and investors with knowledge to make sound financial decisions. This comprehensive strategy aimed at rebuilding trust and revitalizing a once nascent industry. As the remnants of AltaMIRA faded into history, a new era of mutual funds began to take shape, emphasizing sustainability and resilience in an uncertain financial world. The transformation in mutual fund strategies highlighted the importance of education in investment decision-making. Investors began to seek knowledge, understanding the complexities of financial markets and the products that inhabit them. This shift marked a significant departure from previous decades, where blind trust in financial advisors often prevailed. Learning resources flourished, with institutions offering courses and seminars to equip individuals with the tools necessary for informed choices. Financial literacy emerged as a guiding principle, fostering a more discerning public. This region witnessed an increase in online platforms dedicated to demystifying investments. They provided accessible information, empowering individuals to engage with their financial futures actively. Glossaries, tutorials, and simulation tools became commonplace, nurturing a culture of inquiry and understanding. These changes also prompted mutual fund companies to adapt their marketing strategies. Clear, concise communication became essential as firms sought to attract a more educated clientele. Transparency in fee structures and performance metrics gained prominence, allowing potential investors to scrutinize offerings more closely. The emphasis shifted from merely promoting returns to creating educational content that fostered a deeper understanding of risks and strategies. As investment choices proliferated, the focus on education led to a more empowered investor base. This maturation of the market reflected a collective acknowledgement of the necessity of knowledge in navigating an evolving financial landscape. Reflections from former investors reveal a profound sense of disillusionment. They recount their initial optimism, lured by promises of exceptional returns and financial security. The allure of AltaMIRA, with its innovative approach to mutual fund management, initially inspired confidence. Many believed that investing in this entity would secure their future, an assurance that conversations often drift to the moments when early warnings began to surface. Subtle signs of mismanagement and internal discord became apparent, yet optimism persisted among those who had committed their capital. Recollection of board meetings and quarterly reports often highlighted a growing disconnect between expectations and reality. This region of financial history serves as a reminder of the delicate balance between ambition and accountability. Investors reflect on the gradual erosion of trust. Promises once made faded alongside the performance metrics, leading many to reconsider their financial strategies. It became increasingly clear that the foundation upon which AltaMIRA was built was not as stable as initially believed. The echoes of financial loss resonate through conversations, underscoring the lessons learned in a tumultuous market landscape. With the passage of time, the narratives surrounding AltaMIRA have transformed into cautionary tales, emphasizing the necessity of vigilance and informed decision-making in the complex world of investments. The financial services industry has undergone significant transformation since the decline of AltaMIRA. Emerging technologies have reshaped traditional practices, leading to the creation of innovative platforms that prioritize accessibility and efficiency. These advancements have introduced new players to the market, often challenging established firms with their agility and fresh perspectives. Regulatory frameworks have also evolved, reflecting the necessity for increased transparency and consumer protection in a rapidly changing landscape. This region's regulatory bodies have sought to adapt to the complexities introduced by digitization and globalization, which have blurred the lines between domestic and international markets. Increasingly, data analytics and artificial intelligence are utilized to enhance decision-making processes, enabling companies to better understand consumer behavior and manage risks. Financial services now cater to a diverse clientele, embracing tailored solutions that address individual investment goals and risk appetites. The shift towards sustainable investing has further influenced the industry, with an increasing emphasis on environmental, social, and governance criteria. These principles have prompted firms to reassess their portfolios, aligning them with ethical considerations that resonate with a growing demographic of socially conscious investors. As the industry continues to adapt, it remains a reflection of broader societal shifts, illustrating the ongoing interplay between innovation, regulation, and consumer expectations in this complex arena. The enduring lessons from this journey highlight the intricate dynamics that govern financial enterprises. AltaMIRA serves as a case study in the importance of responsive governance and strategic foresight. This company, once poised to revolutionize investment accessibility, stakeholders observed the gradual erosion of trust as the firm struggled to maintain its promised value proposition. This erosion was not merely a consequence of external pressures, but also stemmed from internal miscalculations. Decisions made in isolation, devoid of holistic comprehension, can precipitate cascading failures within an organization. The palpable disconnect between innovation and execution underscores the necessity for adaptive strategies. Examining the remnants of the company's trajectory reveals a landscape of missed opportunities. It becomes evident that proactive engagement with both consumers and regulators is vital. These lessons resonate beyond AltaMIRA, serving as a reminder of the imperative for continuous learning and adaptation in the financial sector. The once promising venture stands as a testament to the challenges inherent in navigating an evolving market, emphasizing that success requires vigilance, agility, and a commitment to addressing the shifting expectations of those it serves.